It's such a pleasure to be here. When I met Joe, I guess what was it, about a year ago at the University of Toronto, we had such great interaction, and we both shared this belief. I've been at a business school as a professor for all my career, and teaching finance and international relations. But I'm also an economic historian focused on financial history, and I don't really believe that we can do these things in separate brains. So I think that your commitment in the Business History Association to putting those things in the same brain makes me feel very welcome and very in sync. Can you hear me okay? Great. And thanks to Joanne for, she's going to advance the slides, and I hope you can see them. I hope I can see them too, because I don't have a copy of them here. So we'll see how that works. But before I get into this comparative discussion of banking performance, I was so inspired by the conversation we just heard. And in fact, by a link between something that Joe said in his comments and something that the other two speakers said. So when I was writing this book with Steve Haber, we wanted to figure out questions about comparing banking system histories across countries and trying to understand why some countries' banking systems are so much more successful than others. And I'm going to show you a lot of data about that in a second and explain to you how we think about that and how we're going to peel that onion of measuring performance. We're going to peel it down to its political core to try to understand why the political environment shapes bank performance so much. But before I get into those criteria and talking about the two criteria that we're going to talk about, which is a very good way to measure bank performance, is a twin criterion. How stable is the system? That is, does it blow up every Sunday? And secondly, how deep is the banking system's ability to provide credit? So I'm going to show you some data that will have these two big measures. Is the banking system blowing up every Sunday? Is the banking system, as a fraction of the size of the economy, able to provide a lot of credit? And what we're going to see, really remarkably, what was shocking to us is just how much variation there is across countries. And as to give you the, I'll do Al Chandler's advice that Joe cited. I'll tell you that the answer is that the hero of the 18th century is Scotland, and the hero of the 19th and the 20th century is Canada. And that was not a complete surprise to us, but since I'm going to talk about those two criteria that I mentioned, banking credit depth and stability of the banking system, because of this great panel you just heard, I have to tell you about a third dimension, which is innovativeness, which is pretty much the same thing as customer service, which you also raised. So when I was a young professor in the 1990s in the US, I was one of the main academic advocates of universal banking. And where did we see universal banking operating? Believe it or not, you know now where it was operating, here in Canada. Now, the World Bank did a very influential international study in the mid-1990s of financial innovation and consumer services in banking. And Canada was at the top. What was going on? I thought, aren't those Canadians just kind of sleepy monopolists up there in Canada? And the answer is, another friend of mine, Charles Schaffer, did a paper that showed that despite the concentration of the Canadian banking system, it was highly competitive. So here I am as a young assistant professor, and I'm finding out the most concentrated banking system in the world is also the most competitive and the most innovative. Well, that really is interesting, and that's what the academic literature was saying about Canada. Now, as a financial historian, I also knew from studying of financial crises in the US, particularly in New York City, that the Canadian banks had a particular history in New York City. So whenever there was a banking crisis in the US that gripped New York City, I don't know if you were aware of this, but depositors in New York City would often flee to the Canadian bank branches located in New York City. So here I am as a young assistant professor wondering, what the heck is going on up there in Canada? They are creating consumer confidence even outside their borders, but also innovation, stability. Never had a banking crisis. Innovation, stability, in the face of also, as I'll show you, extremely high credit to GDP. So that you can understand that the overall puzzle that we came to in our book was, well, why are countries different? But it fits very nicely that I'm able to piggyback on the discussion we just had, because that's a dimension, we don't talk much about it in the book, but the academic literature did point to it. Now, what's the connection to what Joe said? So here I was in the US as an assistant professor advocating universal banking. By the way, I had a pretty good partner advocate. His name was Alan Greenspan, who was advocating it from the mid-1980s and pointing out that US banks couldn't compete and couldn't be efficient if they weren't allowed to go into other areas. But as you probably know, we didn't really fully get there until 1999. So from the early 1980s when this was apparent, it was 20 years until we finally got the legislation. And one of the things I noticed was every year there was a lot of congressional discussion about possible legislation. And those congressmen and senators got big campaign contributions every year. No wonder they didn't want to pass the law. You pass the law, you stop getting the big contributions. Now think about what Joe said about you have the constitutional requirement and a legislative requirement ultimately that requires that the charters are renewed every 10 years and then later every 5 years. And that means that everything's up for grabs. So my explanation before I even came to write this book with Steve Haber was, wow, the key to making the banking system have to rethink itself and keep itself up to date and innovative was that the charters, that the politicians had to act. They had to act every 5 years. Whereas in the US, they had some pretty strong incentives not to act, but to keep talking about acting. So it was a really interesting dimension that was very clear to me. The other thing that nobody's mentioned, and I'm not going to talk about it much, although you'll see it in a graph in a minute, in comparing the US and Canada is, you don't hear people in Canada talking much about their shadow banking system. Why don't they? Because they don't have one. Okay, why don't they have one? Because again, every 5 years, they remake their banking system. So in the US, if you don't innovate your regulation structure for 20 years, then what happens is all sorts of things that aren't good ideas don't get fixed in the regulatory structure. Regulation Q, as well as all these limits on bank powers. And what does that do? It creates shadow banking. So you're going to see that when we get to the graph, that prior to the 1980s, Canada and the US, in terms of bank credit to GDP, are tracking each other almost unbelievably. All these data I'm going to show you come from completely different sources, and they look identical. But then after the 80s, what you see is the US is below Canada in credit to GDP substantially. And why? Because starting really in the 60s, the US starts to develop a major shadow banking system to financially disintermediating from the banks because of the inefficient regulatory structure that doesn't get changed. So I just want to, that's not my presentation. I hope I don't get charged for that extra time. But the point is that this last conversation you just had just points to, again, the question, why? Why is that Constitution different? Well, I'll point to that. But then why is the legislative structure different that's requiring this with such major consequences? And along the way, let's just note the facts that having a concentrated banking system, according to the academic literature, doesn't mean a less competitive banking system. That's kind of interesting too. Okay, so let's now get back to where Fragile by Design starts off. It says, how do we understand all these countries' differences, which are dramatic, just across these two simple measurable differences, which is going to be bank credit to GDP, that's financial depth, and how frequent crises are. When I'm going to use the IMF team's definition of a banking crisis, which is either a time of sudden upheaval and withdrawals on a massive systemic basis, not just one bank failure or one withdrawal, but systemic, or a very large fraction of the banks actually failing. So that's a Levin Valencia study that uses that. That's a study, that's the same criterion I've always used in my analysis. It's important to mention that because through most of US history, we have both. But we don't have both all the time. So from 1873 until 1907, it was pretty much just the sudden upheavals of withdrawals, not massive numbers of bank failures. Whereas in the 1930s or the 1830s or the 1850s, we had massive numbers of failures, and in the 1980s too. So I'm just saying, I want to be very clear, banking crises can be thought of in two different ways, and they are two different kinds of events actually. Unfortunately for us, south of the border, we got more of both than anybody's ever seen in the developed world. So let's just look at these criteria a little bit. I just want to emphasize the thing that also got us angry enough to write this book, because it was a huge effort to do about a decade ago, was how much the banking literature in the academy was so ignorant because they weren't knowledgeable of this history. So all the banking models that you'll find that I have had to teach and criticize, they just talk about banks as ahistorical creatures. And then because so much of the academic world comes from the United States, this is the really laughable thing. Finance professors all think banks are unstable, inherently. And so you say to them, where's the subscript in your model for the country you're talking about? They say, what are you talking about? Banks are inherently unstable. Well, then how come in New Zealand and Canada and Malta and Singapore and historical Scotland, and I could go on, they aren't, but here they are. I don't know what you're talking about, is the answer. So how can you have a sensible understanding of this pretty important topic? Like, what do we have a good banking system or a bad one? If you start off assuming that the individual country identity must not matter. It matters really a lot. Okay, next slide. So I want to emphasize there's huge heterogeneity across time periods as well as across countries. And that's really what I want to talk about here mainly. And there are different kinds of crises that are happening in the US over different time periods. But the key fact I'm just going to sort of emphasize is these countries differ a great deal in terms of their crisis frequency, and they also differ a great deal in terms of their bank credit to GDP. Next slide, please. So first of all, just to give you a sense, so there's some countries that over the last 30 years, and by the way, in the case of the country we're in, over the last 200 years, have never had a banking crisis. That doesn't mean that they didn't have some banks that got into trouble. Some failed, in fact, but never, by the definition that I started with, never a banking crisis. And then there's some countries that have had one, and then there's this basket case group just over the past 3 decades that have had 2 or more. And the funny thing is, when you read the names of the countries that have had 2 or more, you know, you probably could fill in a lot of the names: Chad, Democratic Republic of Congo, Argentina, and the United States. What? Wait a minute. How did that get in there? So in the developed world, the US is an outlier, and not just for this 30-year period, but as we're going to see, it's an outlier throughout its history. Okay, next slide. Now, in terms of credit to GDP, I hope you can see from this graph, the countries are pretty different. So notice that this isn't measuring credit. This is measuring credit over GDP. So you'd think from a demand side, countries should be pretty similar in the size of demand for credit relative to GDP, right? But they're not similar in terms of the amount. And why is that? Because something on the supply side is determining that variation. I'm not saying that the demand side can't vary with the level of GDP, so there could be slight variations driven by the demand side. There can be, and we could talk about that, but it's distracting. The main focus I want you to have is back down there in the far left. See the corner where the ratio of credit to GDP is 0? Can you read the name of that country? No, you can't. The two there are Democratic Republic of Congo and Chad. Wait a minute, you might say. I thought you said they were the countries that had the most frequent banking crises too. Oh, yeah, that's true. Okay, so if you came to this comparative analysis thinking, oh, I know what causes banking crises, lots of credit, too much credit. No, actually there's no correlation. There are some countries like the US that have abundant credit. It's over there in the top, pretty high. Abundant credit to GDP. Why is it smaller than Canada, which is the next black line next to it there? Well, as I already pointed out, we have a big shadow banking system because of our regulatory problems, which you avoided with that periodic regulatory renewing, right? But so we happen to be one where we have lots of crises and pretty high credit to GDP. Democratic Republic of Congo and Chad have very little and very credit to GDP, very high crises. So these are actually, they're related phenomena, but often they're related in ways that are positive. But in our book, what we tried to do is talk about how this really is very regime dependent, and that really the secret to understanding cross-country differences is to be able to think about countries as operating under different categories of political regimes that create either that very positive or very negative, or sometimes positive and negative. So that it's not a simple correlation one way or the other, it's really politically regime dependent. So I want to talk a little bit about that now. But notice that you should be shocked, because every element, banking, this is not building a robot, okay? This is not getting the man to the moon. This is simple stuff. Everything in commercial banking was invented by the Scots pretty much by the middle of the 18th century. They had clearinghouses, they had interest-bearing deposits, they had bank notes circulating, they had lines of credit, and they had branch banking, which it was a really great invention, and which really promoted Scottish economic development. Scotland in 1700 was a dirt poor country, and by 1750 it was a rich one. And that was very much a story about banking innovation and development, which Canada copied. And Alexander Hamilton was aware of it and wanted to copy it too. Politics did not let him. So this book is all about politics. I know that I'm so happy that Joe gave me the 3 hours that I asked for to be able to present it to you, this comparison fully. But actually, I'm quite aware that we have very limited amount of time. So let me just try to give you a little bit of a sense of what I, as a historian and social scientist, mean when I say explain. Okay, what I want to do is explain why countries are different, not just describe it. So if I said to you, oh, it's because their regulations are good here and their regulations are bad there, well, where do the regulations come from? They are coming from a political process that decides either to do things well or badly. And what we tried to argue in our book was that the banking structure, the chartering structure that a nation state puts together is one of the most fundamental windows into the nature of the allocation of power in that society. And countries are different. Roughly speaking, the US is a populist democracy. It was a revolutionary country. I don't know if you're aware, we had one of those. Canada, we like to call a liberal democracy. And in fact, it was the anti-revolution country by design. That's not just a little fact. Those facts, along with some other things that are particular about Canadian history, like starting off as the British government with a population that all hates your guts. Having a geography that requires all future economic development to happen horizontally across a space rather than the way the US developed in its colonies vertically along a coastline of temperate climate, right? So those actually created unique challenges that helped to shape the fact that it was still part of the British Empire and had those challenges, helped to shape the Canadian constitutional structure in ways that made it a liberal democracy, and particularly, as Joe pointed out, created a national centralized authority over bank regulation. And that is very important, whereas in the US it's quite the opposite. Now, let me go on. I don't want to get too hauled up. Just to say to you, how many countries in the last 30 years or so, actually it's 40 by now, have both what we would call abundant credit, high credit to GDP, and were free of crises? And the answer is 6. And we like to think that these are two categories of countries. First, extremely homogeneous small countries. That's Singapore, Malta, and Hong Kong. And secondly, countries that are liberal democracies, despite the fact that they have conflicting non-homogeneous populations. So what do I mean by homogeneous? In Canada, you've got, in the late 19th century, you had exactly the same political struggle between Western agricultural populists and Eastern manufacturing interests that you had in the United States. Identical. They had similar political preferences and they pushed for similar things. What was the difference? In Canada, they lost. In the US, they won. And that was because of the constitutional structure, which was itself the outcome of the political grand bargain that tried to actually anticipate those kinds of problems and prevent them. Think about it this way. If you're the British circa let's say after 1836, what have you learned? I'm sorry, and I'm not trying to disparage the history of French Canada, that they were very uncooperative, right? They actually almost had a revolution in 1836. And they were actually blocking the building of canals and railroads going across the country as part of their strategy for suing for independence. So you had, if you had given decentralized authority to Lower Canada in perpetuity, you would have really screwed up Canadian history from an economic development standpoint, which is why the Constitution didn't do that. By the way, they started off wrong, right? And then they learned. They started off actually giving it political autonomy and then realized they couldn't and have a successful country. And it didn't hurt that the British Empire was still in control of a lot of that decision-making and wanted Canada to be its jewel in the crown, if you like. And there's still Canada Day. If you haven't been to London to celebrate it, it's a lot of fun. I recommend it. And you've got the King's picture still on your money. And the King still appoints members of your Senate. Wow. That's what a liberal democracy does. Those things we call in political science veto gates, that they prevent populist pressure. But of course, you couldn't have populated Canada if it was an autocracy. If you had what were the names of those little cliques? One of the names even had clique in it. Come on, your business historians. Thank you. Family Compact was one, and then the other one was? Thank you. So if it had just been that forever, people wouldn't have wanted to come as immigrants from Britain to Canada. So that's why Great Britain realized you had to create a democracy, you had to create representative pluralistic government, but you had to also not let the disgruntled French destroy the country. The Canadian Constitution was the answer to that puzzle. Brilliant threading of the needle. The US was a different constitutional history. We had a revolution. And that revolution left a lot of people not wanting to see centralized authority and a lot of other things. Now, that's the point of this book. The point of our book is, if you want to understand why countries have different banking systems, you have to go there. Because those are the things that actually decide what regulations get passed. Okay, so there are only 6 countries. Why does this homogeneity small matter? Well, bank regulations that are inefficient are usually done in countries as a way to take from some group to give to another. But if you're all the same, there's nobody to take from. So the other 3, they're countries that have a history of liberal democracy that comes out of experience like what I just described in Canada. Okay, next slide. I'm conscious of our time, so I hope you'll buy the book and you can read all about it. So I won't talk about the bad side. There's a flip coin of the bad countries. Autocracies aren't good for banking. They tend to inherently, we would say structurally, that is theoretically, not be able to generate high credit to GDP, partly because property rights are so contingent. If you're worried about whether this autocracy can hold itself together, do you really want to put a lot of capital into a chartered bank? You don't. So autocratic property rights risk tends to inherently limit the size of banks, and it also makes them very unstable, especially when autocracies collapse, or when they just decide to take things from the banks. If you're in a country like Venezuela or even other Latin American countries, you would experience that. So instability and low credit are kind of inherently problems in autocracies. Democracies can achieve, liberal democracies can achieve the best of both, but populist democracies like the US tend to be very crisis prone. And the reason is because they are pursuing strategies where sometimes we create a regulatory structure that benefits some at the expense of others. And that creates inherent instability, because one of the best ways to benefit people in that kind of subsidization is to give them an invisible benefit, a credit subsidy that you can't see very easily. Unit banking in the US historically was one of those examples, and the kind of real estate credit subsidies that led to the financial collapse in 2007 were a very different kind of example. What they have in common is people didn't really understand they were being taxed. And that's a great tax. Every government bureaucrat wants to be able to tax people with something that they don't understand. Right? And that's what's great about using the banking system. In a populist democracy where you don't have the veto gates to prevent coalitions from grabbing control over the banking system for that purpose, that's what happens. Okay, let's keep going because I know we don't have forever. We'll skip that, we've already talked about it. And we'll skip that because I'm sure I've talked about it. And we'll skip that. So we like to talk about this, the rules of the game being the political history of the country that gives rise to something we call the game of bank bargains, where coalitions form that are the winning coalition that get to decide. So for example, from Alexander Hamilton, already mentioned by Joe, of course, brilliant guy. But by the 1830s, Hamilton's ideas are irrelevant for banking structure in the US. His ideas for the US Treasury and our currency remain important. But his ideas for banking are displaced. The rise of the populist movement of unit banking. And unit banking seems like a bad idea no matter who you are. Why would you not want to have a diversified bank, rather have a bank with a single office that can only be located in one location? Sounds crazy. Very undiversified lending, terrible. And so in the book, we explain why, from the standpoint of agricultural borrowers, they saw that as helpful because they were also undiversified and they liked having lenders who would be there for them because they had nowhere else to go. That's basically the structure of the fragility of unit banking. Next slide. So it's a pretty regular phenomenon. We've actually kind of, are used to it. If the banking system doesn't blow up, many of us were relieved in 2023 when we had another one, which isn't even on our list, because, we figured, well, it's been a while. It's 2008, and it's 15 whole years. We should get another one, and we did, and we'll get another one soon, by the way. There are 600 banks that are insolvent in the United States right now. And they're not being shut down because they have all insured deposits, so the depositors don't care, and the regulators are looking the other way because of a political decision to do that. Commercial real estate, by the way, what do banks lend to in the US? We call them commercial banks. We should call them real estate banks because 75% of their loan portfolios are real estate. Commercial properties haven't recovered in the US, in case you haven't noticed, since COVID. And when we have a recession as a result of the tariffs, which I think is only a couple months away, the commercial real estate market will collapse. We will have another banking crisis with hundreds of failed banks. You didn't expect me to say that probably, because this is a history. I actually know, call me Nostradamus, okay, here it is. I'm telling you, you're gonna see another one and it's gonna happen real soon. Next slide. I told you about this. Isn't this remarkable? When you look at the credit to GDP ratios in Canada and the US, I constructed these myself. I did them from original sources, pulling them together. None of these things are connected. They're not all coming from the IMF or something where you could wonder what the hell's going on. No, this is all from completely different original sources. I think it's remarkable. So what it's telling you is, of course, both credit supply and credit demand go down during recessions. And because our two economies have been so integrated, we tend to have business cycles that are integrated, and so the movements tend to be very integrated. That's really remarkable. But then you can also see the shadow system in the US versus the Canadian system in the last piece of that diagram where you see the red line above, right? You with me? Everybody still awake? And I know I'm out of time. How bad am I? Got 5 minutes maybe? Okay, next slide. Okay, so let me show you just a little bit of more like, this is the way finance professors, this is why I get paid so much. Next, yeah, bring them all up, right. So I could have picked another date, but I think it's good to pick this date because it's very early. In 1904, now when I'm looking at banks, assuming that the commercial lending risk of a Canadian and US bank loan are similar, okay? And I think that's reasonable because they were both doing commercial lending mainly, by which it means financing merchant movements rather than industrial lending. That's what both were doing. So commercial lending is a big deal. They're similar risk. Okay. So how do you achieve low risk for your depositor as a banker? So all the risk is coming into the bank through the loan portfolio. The way you mitigate the risk is you have two different levers that you pull. One of them is that you don't leverage so much, so you keep your capital ratio. If you are worried about your risk, you increase your capital ratio relative to deposits, right? The other one is on the asset side, you hold more cash assets relative to loans. Those are your two levers. If you think your risk is getting higher, you increase your cash to assets or you increase your capital to debt. Either lever, right? Okay, so when you're looking at the US and Canada, let's look at the cash assets ratios in 1904 and the equity asset ratios. And what you see is cash assets of US banks are higher than Canadian banks, and equity to assets ratios are also higher. Wait a minute, hold on. From this standpoint, if I just showed you these data and didn't tell you anything else about the countries, you'd say the US banking system is probably a lot more stable, right? No. The reason that the banks had to hold more cash and more capital was because unit banking as a portfolio of loans was less diversified and therefore required more capital and more cash, and still they had banking crises. And I want to emphasize there's a second part of the risk mitigation. It's not just diversification that comes with branch banking, it's also ex post coordination. Prior to the creation of remember, by the way, we had a Federal Reserve in 1913. You didn't have a Bank of Canada until 1935. But you had this thing called cooperation among a small group of banks. 100 years ago, maybe it was a dozen. Before that, maybe it was 20, 30. It's still a small number. And they're all geographically coincident in their networks. So they're all able to be pretty much aware of what each other is doing, right? When you had a crisis, it only happened twice in the first decade of the 20th century, that a bank got into trouble in Canada that the other big banks were worried could lead to lack of confidence in them. In both cases, the Bank of Montreal got together with the other banks and agreed to take over the failing bank. And before any depositors were really aware of the problem or might be concerned, the Bank of Montreal took them over, put its own signs in front, and then all of the whatever costs that were incurred from that were shared by all the surviving banks, as well as the reallocation of the branch network. Now, but they didn't do that every time. In fact, they only did it twice. So what was interesting is they had the flexibility and the wherewithal to see when a true sort of systemic contagion event might be there, or a risk of it, which we could talk more about. So I thought that was also interesting. You couldn't do that if you didn't have a highly consolidated system. So the branching didn't just create diversification ex ante, it also created the possibility of coordination ex post, which in at least 2 cases was used. Next slide. I just want to emphasize, Scotland was, of course, the great example. Everybody knew Scotland's success. Hamilton knew it. And of course, as Joe's already pointed out, Hamilton had a big influence on the Bank of Montreal's charter. But the difference between seeing Scotland and being Scotland is politics. Next slide. Do we have another? Yeah. Okay, so again, these are the details of the sequencing. And I want to emphasize the particular banking structure changes over time. We have a grand consolidation in the 1990s and 2000s that happens in the US. We give up on branch banking, but by the way, it's still pretty late. When is branch banking gone in the US? Completely gone. Limits on branch banking, 1997. So, and it's replaced ultimately by this new thing, which is this merger wave. Next slide. So you can see that that's what the merger wave looks like. I'm sure you're all familiar with it. Next slide. Okay, so why did it happen? When it happened? We spend a lot of time in the book talking about that. I'm not going to take time on it tonight, but I think it's quite interesting because it almost happened 60 years before, but didn't. And that's what really illustrates the importance of understanding the political coalition, because the logic for getting rid of unit banking was there all along. And there were moments like during the Great Depression when it was considered but rejected. Next slide. So, okay, so what you might think, oh, finally we're going to have the Hamiltonian Scotland Canadian dream of consolidation and efficiency. I've already told you universal banking, we don't get that till 1999, but still, okay, we're going to finally get there, right? Not so fast. If you're a populous country, you're still a populous country. So mergers have to be approved, and that's a political process. Even though it's done by the Federal Reserve Board. The Federal Reserve Board is a highly politicized institution. That's a lecture for another day. So the Federal Reserve Board has to approve every one of these mergers, and it has 2 criteria that have to be satisfied. Not too much concentration in a local deposit share, and good citizenship. Oh my goodness. Good citizenship, what does that mean? Whatever you want it to mean. Okay, so you're going to laugh, but now we're going to do a quiz. Those of you with great perspicacity, with numbers, this is your moment to shine. So when the banks apply for mergers, they hire people, they pay people a lot of money to come testify that they're good, that they have good behavior. And you've heard of some of these people who testify. Jesse Jackson. So they come and they testify, but they are paid, and it's actually known how much they're paid. They're paid, there's a contract. It's thick, and it lasts for about 10 years to their organization. 10% of that payment is outright grants, 90% is loan pass-through. That means that if you're Jesse Jackson, you give loans to people who are part of your organization if they show up for your protests. You check the box. If they show up often enough, they get a subsidized mortgage. So the bank that's merging is going to give money to these organizations so they testify for the merger. And by the way, that's only the beginning, but I can't go through all of the facts, but they're going to testify for the merger. How much, what is the total aggregate from 1995 to 2007? What is the aggregate amount of contractual publicly available? They're redacted, you can't read them, but they're there, we know what they are. What's the total amount of these contractual agreements as part of testifying at the Federal Reserve Board, which was necessary for getting the merger approved? So you can kind of start to see how the politics is being expressed, right? Urban activist groups have blocking power. How much? Come on, what's my first bid? Start the bidding. Okay. Well, okay, you got it wrong. It's only half that. But you were joking. Yeah, 2.5 trillion. Now, remember I said the greatest thing about a tax is if people don't know that they're paying it. Now do you understand how populist control of banking systems works, whether it's unit banking or the bank merger? Now, there's more to this story which has to do with how are the banks going to actually do this? Well, they're going to have to flog it off onto somebody. Who? Fannie Mae and Freddie Mac. And so we're going to get requirements that Fannie Mae and Freddie Mac buy mortgages from these urban areas. And the requirements as a percentage of their portfolio are going to rise over time. And that's going to allow the banks to be able to give your money, our money, taxpayers' money away in this form. It's complicated. It's kind of interesting. The guy who designed this was a Senate staffer in the Senate Banking Committee who's very proud of it and explained to me that, yes, of course, he saw the whole thing as he was doing it. So it's not that just happened. It was a strategy that comes from a particular political system and a way that decisions are made. Next slide, and I think we're wrapping up. So anyway, I've already told you what the deal was. The GSE Act was part of it, but I'll show you a graph or two so you can see. So this is the sort of bad mortgage. This is the total amount of subsidies that I described to you, the 2.5 trillion. Next slide. How it grew. This is the GSE Act's portfolio percentage requirement in underserved areas, that has low income or urban mortgages that have to be held, which is part of that same equilibrium so that the banks can actually afford it. Next slide. This is also what happens to the credit quality deterioration, the percentage of mortgages that are made with basically no down payment and eventually with no documentation. Why? Because if you're the banker, the only way you can meet your requirement, the prior slide, was to debase the mortgage lending standards. So this was really about a housing credit subsidy. Again, invisible subsidy. Again, using the banking system as a tax and transfer system. Next slide. And of course, it's silly to think that the regulators, just because they had this ridiculous thing called Basel, were really doing anything. Just like the regulators right now aren't doing anything about the 600 insolvent banks that we have. Next slide. Okay, I think I'm going to stop there. Next slide, and I think we're basically done. Now here, I'm going to talk about the good story, but I've already told you about it. It's a story of a constitution, a centralization of authority, the existence of veto gates. The Senate blocks populist banking. Remember, there was somebody here will know the year. In the 1890s, one of the Treasury ministers of Canada tried to change the banking law under Western influence to create unit banking law in place of branch banking law. And he got it through the lower house in Canada, but not through the Senate. Why? Because that's why you created the Senate, with some British government oversight and complicity, to be able to prevent populist regional interests from using the banking system as a political football. It worked great. Next slide. Why did Canada make this choice? I've already talked about Canadian history. It comes down to geography, comes down to initial conditions of French population. Next slide. Okay, so I'm going to stop here. I have lots of other slides to talk about this nature of this political deal currently in the US, about real estate subsidization. And this is a paper where we showed that it had big voting effects too, but I'm not going to go into it. I just want to flag, we'll do next slide quickly. Broad conclusions. I want to emphasize one we haven't talked about, which is, I call this Calomiris' law of banking, and I only have one, which is when the sovereign is in an impecunious credit state, you can't have viable private credit because the sovereign will always eat first at the table. And that is I didn't talk about any of the history that shows that. The Civil War is an example of it in the US. Better example is the Bank of England until 1825 was basically just a sovereign financing vehicle. That's what it was created for. So we are now looking at fiscal crisis in the US, not just in the US, but certainly in the US. And I have a paper that explains how it's very likely that as part of the solution to that crisis, we're going to trash the banking system. Why? Well, to increase the inflation tax. The way you currently the only tax base for the inflation tax is currency, which is about $2 trillion. Why? Because we have no reserve requirements and we pay interest on reserves at market rates. So if you want to trash the banking system but get revenues for an impecunious government, what you do is you impose, let's say, 20% reserve requirement with zero interest. When the US government hits the wall of sovereign credit, it's going to do that. Or it'll fix the sovereign credit problem. But I'm not betting on that. Next slide. So I've got a few applications that I'll just point you toward. Very easy to understand what happened in the 2023 crisis, if we wanted to talk about that. Next slide. I've already talked about this. What's going to happen when we hit our fiscal wall? That's what I just talked about. And number 3, stablecoins. So I was a chief economist at the Office of the Comptroller of the Currency and was working on stablecoins in 2020. And then I left, and now stablecoins are coming back. There's a really interesting question to ask to apply our techniques of using our understanding of political process to understand how stablecoins are going to play out as a technology differently in different countries. So I just want to say, bless you, that's a fun topic for us to talk about. And I think with that, I'm done. Thanks very much for your attention. I'm sorry to keep you from the drink.